Let's start with our eighth chapter. So, what does my eighth chapter basically is? Uh, in my eighth chapter, I'm going to see an extended version of what happens in the seventh chapter. So, if you see that in the seventh chapter, we developed a single index model. Okay. So, what was this single index model linked to? It was linked to nothing but market. That is, if we want to see in reality what will it will be linked to, it will be linked to Sensex, Nifty 50, etc. So basically, we're using this market to determine several different observation which investors see, which would be used to price the asset, as well as it helps the investor to select which asset they want to buy. Along with that, we will be seeing several different mathematical things such as finding the expectations, variance of the market, etc. So basically, this chapter is nothing but an extension of the seventh chapter. So I just wrote the common assumption which we have seen from chapter 6, 7, and 8. So what is the common assumptions? The first common assumption is risk averse. So basically, what does risk averse mean? It means that an investor dislikes risk. So basically, an investor would always prefer to invest in an asset which provides a higher expected return for the same variance. It was even seen in chapter 6, that is the part 1 of chapter 6, if you can see it here. So it's risk averse. For a given level of expectation, I would like to minimize my variance. So that's the main aspect. We want to minimize the variance. And an investor therefore does not like risk. What do you mean by a rational investor? So rational investor always would prefer more to less. So basically it will always choose an expected return having the higher percentage. So it is nothing but our word of non-satiated. For a given level of variance, I would like to maximize my expected return. So basically it would always prefer more expected return rather than a less expected return. The third point is related to the buying and selling. So basically, all the buying and the selling of assets could be done at any point in time. So, and there is no restriction on a person to basically buy certain number of assets. So if we take a hypothetical situation of an investor buying about 10,000 shares, but in reality, if the company is small and 10,000 require is about suppose 1%. So in order to make this trade, there is always several restriction because this is such a high volume. So, but in this example, in these chapters, we would consider that there is no restriction, okay, on buying and selling. Do you know this? I'm just saying this for your general knowledge. But yeah, after the 2008 crisis, there were several regulation changes made. So what were these regulations? If you have seen in 2008, in one day, there was a drastic fall of about 10 to 15% of a single stock. So basically, if a stock has a value of rupees 100, it fall to about 18 just a single day. That is people losing about 20% of their wealth in just a single day. And there was certain stock which rose to about 10 to 15%. So there were certain stocks such as the pharmaceutical industries. In one day, it rose to 120. So basically, if you have seen, there was such a great volatility in just a single stock. I'm just saying a single stock. A single stock experienced this, not the whole market. So basically there was a lot of volatility seen in reality. So there was a new regulation added. So what was that new regulation? Basically, if you even see, it even exists in the Indian stock market. So what is that regulation? The regulation basically states that if a stock increases by certain percentage, let assume it to be 10 percentage, the trading for the day is closed. So basically, if I buy Reliance shares of rupees 100 and increases to 110 after like 5 hours, suppose, but still the stock market is almost traded for like 6 hours. For that remaining 1 hour, you can say that Reliance won't be traded at all, okay guys, at all in the stock market. So basically, if you want to buy Reliance during the last 1 hour, you won't be able to buy it because it was such a high volatile. The company, that is the BSV and the NSE, has to close down that security for the day. And when you seen that next day, there could be a rise and decrease depending, but the percentage is different for different assets. So it could be about 5% for certain asset, it could be 10% for certain assets, and so on. So that's my basic explanation why there is a restriction on buying and selling. So basically, if there is an extensive buying in the market, it leads to higher volatility, right? So basically, in order to cap that volatility, there is a restriction on buying and selling. This was just for your general knowledge. So it's okay. We always state that my asset is nothing but 4% of my wealth, and I buy about 136.87 units. If you have solved 6 and 7 chapter, you would always get in somewhere in points. But if you see in reality, we could only buy stock in the quantity of a number, right? So I can buy 100 stock. I cannot buy 100.1 stock na, in reality. But for a chapter that is a 6, 7, and 8, we are assuming that we can even buy 100.1 stock, 2.6783 stock, and so on. This is unrelated to the reality, I know that, but it is an assumption. Even if you see the last assumption, there are no transaction cost or taxes. So basically, in reality, we see certain transaction cost of 0.01%. That is the Zerodha provides 0.01% and taxes of around, I guess, 1 or 2 rupees. Yeah, 1 or 2 rupees around for each transaction you make. So in reality, we even see, but for the chapter that is the 6, 7, and 8, we are ignoring it altogether. So going ahead. So if you see the 6th and the 7th chapter, the assumptions were quite related. But however, in the 8th chapter, there are certain assumptions. So basically, there are three assumptions which are only related to the 8th chapter. So assumption related to the 8th chapter. So this is the 8th chapter is basically asset pricing model. So the assumption related to the asset pricing model can be also written as capital asset pricing model. So basically all my assets are basically based on a certain amount of capital, right? So I can even call asset pricing model as CAPM, that is the capital asset pricing model. CAPM, it is the short form, and everyone refers this chapters as CAPM only. And even if you see certain sums, so basically they directly ask what is the assumption for the CAPM, which does not include for 6 and 7 and 8, 6 and 7 chapter. So they directly refer this chapter as CAPM. So even you can refer that, it's okay. So what are the three different assumptions which basically we have not seen in chapter 6 and 7? So it is nothing but all investors have homogeneous, that is same expectation of risk and return. So what does this mean? So if you break down all the investor, what does all the investor means? Basic like you, me, or anyone like your friend. All these investors would have a similar view over a certain asset. So basically, if I think Reliance has a return of 10% and risk of that is the variance, let me write it down. Reliance has a return that is the expectation of 10% and variance that is nothing but risk of around 5%. I can say that if I have this expectation, each and every individual will have the same expectation only. So basically, this is my friend Raj. So Raj will also have the same expectation about the Reliance. Even my dad, although he is experienced and have certain knowledge about the company, would also have the same expectation. Even you can say Rakesh Junjunwala, if people do not know, or everyone must know Harshad Mehta, and these are some common names in the Indian market. Even these people would have a similar expectation. So let it be me, my dad, or any higher authority which has a better knowledge towards the stock market. So basically, an expert would have the same expectation altogether. They won't have different expectations. So CAPM basically uses this assumption as this would be used in order for an investor to select an asset. But in reality, however, this assumption is far from being real. So this is the one of the biggest drawbacks also. Okay. So going ahead, what is my second point? My second point states that all the investors would borrow uh, or lend money at risk-free rate R. So what does this mean? So basically, I want to invest in suppose Apple. No, let me take Birthway Hackshire. That is the one of the most expensive stock. It has reached to that level. This is just general knowledge, okay? So it has reached to that level that the maximum amount of a stock value is really close to the birthway Hackshire. So if you see in reality, so let me just Google it up. What is the exact value right now? Give me a second, guys. Okay, so right now, Berkshire Hathaway has a stock value of around 4,37,131 US dollars. Okay, so this is the value of Berkshire. This is the world's most expensive stock. If you want to convert in an Indian rupee, it is nothing but basically multiply by 70. So it is around 2.5 to 3 crore for a single stock. Okay, this is owned by Warren Buffett. This company is basically of Warren Buffett. I don't know the spelling. I guess this is the right spelling only, but yeah. Uh, so basically, this company is owned by, and it has even reached to that level that in USA, a maximum value of a stock can be around 4,47,000 or something like that. So basically, it is just $10,000 far away. So reaching the maximum value of stock can be touched in the US market whole. So it's such a big stock. And if you see like me or you as a common person, we do not have such kind of money. But I want to buy this stock, okay? So this is around, I assume it is about 2 crore 50 lakhs. Okay. It's around 2 crore 50 lakh. I just assume it, okay? Due to like change in value of dollar. I want to buy this stock. I have 50 lakh rupees with me. So basically, I have 50 lakh rupees with me. I want 2 crore rupees. Okay. I want 2 crore rupees. Everyone, it may be you or Mukesh Ambani. You can say any individual can lend this money. So what do you mean by lend? So I could give that money or I could borrow that money. So in this case, as I want, I will borrow that money at a fixed rate of R. But in reality, this assumption basically won't match because there are several disadvantages to this assumption as well. So basically, if you see like you and me, there is a good chance that we will default, right? Because we don't earn so much in 1 year that we can pay this. Even if we earn so much, we do consider certain expenses in our home. So basically, there is a higher risk of default. If there is a higher risk of default, there is a good chances that in reality, okay, this is the reality aspect. So let me write it with red pen. So like you and me, we have a good chance of default. So basically, this would be nothing but risk-free rate plus some additional percentage of 5%. But this for Reliance would be nothing but the risk-free rate. Why? Because Reliance is such a big industry. Its daily profit exceeds 2 crore. Daily profit, okay? I'm not talking about of the whole Reliance company, of one sector if you see. If you even see Geo, it exceeds 2 crore in a single day. So they have the capacity to pay. So there is a less risk of default. Since there is a less risk of default, bank usually give them at a lower interest rate. So, but in this assumption, we will always assume that uh, everyone, that is the you, me, or the Reliance company, would always get this amount as the at the risk-free rate. Even if I want to give it to some other people, I will give at risk-free rate only. Okay. So basically, my third is asset market. That is not normal, but a stock market is perfect. What do you mean by the word perfect? Perfect could be subjective now. So basically, for me, something to be perfect, it needs to specify certain objectives. So basically, for me, a Samsung phone would be a perfect phone because it basically uses my need. But for a different person, it could be an Apple phone because uh, that person may be into photography or higher software or something like that. So perfect is subjective. So in this case, what does perfect means? So in this case, oh, where's my pen? Huh. In this case, perfectly because to refers to no information or symmetry. What do you mean by this? I will get to it. It is large number of buyers and sellers. Okay. And the last point, it is free entry and exit. So if you read this two part, that is the second and the third part of the perfect market, it is nothing but related to your economics which you did in college. So basically, if you even read this, you can understand that there are large number of buyers. It is not a monopoly market. Monopoly's market is nothing but it is dominated by a single person, and anyone can come in, anyone can go whenever they want. What do we mean by the first assumption, that is no information or symmetry? So basically, in a market, everything acts on an information. So if you see this COVID times, due to all businesses were closed, the government announced a lockdown. So basically, lockdown created panic, and panic led to people assuming that the business would be closed. So basically, that information of business being closed transfers to each and every individual, and then it acts according to what it was needed. So basically everyone took out their money and etc. So yeah, and we will see this no information or symmetry detail in the first chapter. So if you haven't understand what information or symmetry, it's okay, wait for chapter 1. Okay, so these are the three assumptions related to capital asset pricing model. So now basically for the two asset case in the sixth chapter we saw our efficient frontier, that is the above part. Similarly for n asset case it was the same. Okay, now basically for this chapter we will see an efficient frontier in presence of a risk-free asset. So every asset considered here had certain amount of risk. So any example we take, it is expected return and variance. So variance, that is asset A, B, C, or asset A over A and B, that is in the two asset, it had certain variance. But in this chapter, that is in this part, we would basically, let me just extend it. Yeah, efficient frontier of a risk asset and a risky asset. Okay, so basically what is a risk-free asset to be in general? A risk-free asset is nothing but an asset which has no risk. So basically, some example of risk-free asset is the US Treasury bill. The government basically introducing some bonds. In that case, the government hardly defaults, right? So basically, under any circumstances, government would pay to people. So that is the only reason it is known as a risk-free asset, because there is no risk, government would 100% pay to it. Okay, that is what a risk-free asset means. And risky asset is asset which having certain expectation and variance. That is what we did in chapter 6, 7. Okay, so going ahead. So as we all know, let's consider two assets. Okay, so expected return on my portfolio is nothing but XA plus XBEB. That is nothing but chapter 6, if you can see, is EP is equal to summation of XIEI. Okay, so these are the two assets. Okay, similarly, variance of my portfolio would be nothing but XA square EA plus XVA, sorry, variance XB square VB plus 2 XA XB covariance of AB. So let us consider two assets now, A and B. Okay, this is my expectation, this is my variance. This is basically a risk-free asset. Okay, we denoted the notation of risk-free rate as R. So this is nothing but a risk-free, that is asset. Okay, so it would have certain percentage, suppose 3%, and variance of 0%. Similarly, asset A would have an expectation of about 6% and variance of, suppose, let me say 10%. Okay, it's just an hypothetical example. So if we substitute our value here, we get our answer as XA square VA, which is nothing but 0.1, plus XB square VB is nothing but 0, so your 0, 2 XA XB covariance of AB. What is the relationship between a risk-free asset and a risky asset? So basically, if you want to consider, if you want to consider that a US government bill and suppose Apple stock. So basically, US government, why would they introduce the treasury bills? To basically build roads. If you see the Apple share, Apple is basically technology. These two are different aspects altogether. So basically, what does the government do? The government does certain things that the private industry does not do. So basically, I can say that they are uncorrelated. So I can make a conclusion that risk-free asset and risky asset are always uncorrelated. Okay. So basically, even this turns out to be zero. Therefore, VP is nothing but XA square VA, that is 0.1, and everything becomes zero here. Okay. So from this equation, let me find the equation of XA. So this you must have done several times now. So I assume you must be knowing. So I will be a bit quick. If you do not remember, please solve chapter 6 and 7 before attempting chapter 8 because it is related to chapter 6 and 7 as well. So XB, EB, since XB plus XA is equal to 1, only two asset, and all my amount would be invested, therefore 100%, which is equal to 1. Therefore, EP is equal to XA here plus 1 minus XA EB. So y1 minus xa, so basically xb is equal to 1 minus xa. I shift my xa to this side, the additive sign becomes the subtractive sign. So 1 minus xa, I just substitute it right here. Therefore, if I now do it further, I get my xa, sorry, eb plus xa common, ea minus eb. Therefore, xa is nothing but EP minus EB upon EA minus EB. Let me substitute this value here. So basically my variance is nothing but XA square, that is EP minus EB upon EA minus EB the whole square, and variance is nothing but 0.1. So for a risk-free asset, I can say that this is my equation. Since EP, EB, EA and EB, everything would give me a constant value, this would always be a straight line, okay? Another way of classifying a straight line is nothing but you can say that uh, it is in the form of mx plus c, okay? This is the formula for linear equation, and my always linear equation would always be a straight line, okay? So let me prove we understood it basically because these all values would give you a certain percentage and it would always be positive. So irrespective, it would always be a safe straight line. But let's prove it through a linear equation. So my linear equation says mx plus c, okay? So m is something, x is something, c is something, okay? Let me write this in a standard deviation form. Standard deviation is nothing but root of variance. So if I take root of these values, the first term, that is this term, the square goes away if I take the root. So this becomes EP minus EB upon EA minus EB. Going ahead, 0.1 basically becomes root of 0.1. Okay, so let me write it as it is. Let me expand this. I will take this part as my first part, this part as my first part. I'm just breaking down the numerator, and this part as my second part, okay? So basically my blue part would be nothing but a repetitive part. So let me just split those two. Sigma p is nothing but equal to EP upon EA minus EB into root 0.1 minus EB upon EA minus EB What did my first assumption say? My first assumption said that all investors would have homogeneous expectation of risk and return, and that would be known. So basically, this is nothing but a constant since we would know the value of EA, EB, because for basic analysis we would require this, and for everyone it would be same. So there is nothing called as a risky concept here, so this becomes a constant. Similarly, if you say that this part, if I'm just writing it in a different format, okay, so this part root of 0.1 into EP, okay. So if you say this part is also a constant now because root 0.1 is constant, EA minus EB, since we would know this value, is also a constant. So I can say this is a constant. And EP, this is a variable. Why this is a variable, I will explain you. So basically, I'm a risky investor. So I love higher returns. A risky investor would always want a higher return. So I love higher return. So for me, the EP would be obviously I want it higher. So for a risky investor, it would be always higher. Similarly, for a risk averse person, so basically, if you consider my grandparents, they always want to save wealth and disinvest in risk, key assets. So for them, since there is a lower risk, there is a lower return. So basically, this is subjective upon what a person wants. So this is nothing but a random variable. If I compare this, M is my constant. Similarly, C would be a constant. Only X would be a random variable here. So basically, if I compare these two equations, I can say that basically my sigma P, that is the variance of my portfolio, is a linear equation. Okay, it's a linear equation when there is a risk-free asset. Set. So basically, my standard deviation would be a linear equation. Why did we use this linear equation? Because we can say that now, instead of being it a curve, that is my efficient frontier being it a curve and only considering the above part, now my efficient frontier would be a linear equation. Okay, that was my main reason why I proved it is a linear equation. Okay, so let us understand uh last concept for the day, that is relating to this only, not for the day, basically for the lecture. And in the next two lecture I would be considering one capital market line and the another part is the security market line. We'll understand the concept and do one sum. So that is our plan. It is divided into three parts. The first part is nothing but getting our efficient frontier. The second part is the capital market line. The third part is the security market line. However, there is a fourth part. Fourth part is relating to theory of this chapter. There are basically five models here. We will understand two models in deep, that is the capital market line and the security market line, which I will be doing in the next two lectures. But there are another three models. We will just understand those models and have a brief idea because no question directly come from them. You just need to understand that their concept. That's it. So yeah. So going on, this is my last part. Let me draw the efficient frontier now. Okay. So basically this is nothing but my x-axis and the y-axis. Variance is nothing but in the x-axis and in the y-axis it is the expected return, and this would be my line. Why this would be my line? So basically we are understanding this concept first. This point, suppose Suppose it is an expected return of 2%. If you see my above example, expected return had 3% and variance of 0%. Let it be 3% only, so the above example would be only used. So basically, this point is where I invest 100% in risk-free asset, that would give me 3%, and since my variance is 0, so 3% and 0, that is EP and VP. Okay, this is nothing but uh, how do I write it? I write it in the form of x comma y always. So basically, this is nothing but 0 comma 3%. Okay, this is nothing but variance and EP. So this is the best way of writing it. This way is the best way of writing it, but however, in order to make you understand that how it is written, it is basically based on the x and the y axis. X axis is VP. VP of a risk free investment is 0, so I wrote here 0. Similarly, y axis is nothing but the expected return of my portfolio. If I invest only in basically my risk free asset, then I will only earn 3%, that is a constant percentage. So that's my point. Yeah. Hmm. Sorry guys. Huh. So this is my point. This point, that is which I'm marking it here with red pen. This point is a point where I invest 100% in risk-free and 0% in risky. Okay. So if I consider the two asset case, my model would look like this in reality. So at this point, that is this point, I can say that this is nothing but 100% of risky and 0% of risk free. Why did I state that? I stated it because this point, all the assets in this, that is the red, that is the efficient frontier or the opportunity sets, would always have risky asset. Therefore, even if it meets this point, that is point number B, it will have the same proportion of the risky assets. So basically, it would have only risky assets. Now, if this would be a risk-free asset, if it could include a risk-free asset, then this would basically become a straight line, because we just proved it earlier that it would always become a straight line. But since it is not considering the risk-free asset, therefore, wherever you can touch this point or this point or this point, this point, it would contain certain proportion of risky assets only. So that's why even at this point, that is the point B, it would consider 100% of risky and 0% of risk-free. Okay, at what proportion we are going to discuss later. But for a brief information, I can just say it is based on market portfolio. What is that? We will see in the next lecture. That is nothing but a capital market line. It would be a short lecture. So yeah, this part, okay, what I'm highlighting with light blue is basically my opportunity set. So let me write it with gray pen. Opportunity set in some proportion of risky and risk free. So if you want to assume this line as this line, this is 100% risk free and this is 100% risky. Therefore, at this point, it would be approximate 10% risky and 100% risk free. Similarly, at this point, it would be around 50% risky and 50% risk free. Okay. At this point, it would be 80% risky. This is just an hypothetical example. The point could lie anywhere, right? It could lie here. I have not taken the exact marking, but approximately you could understand it, yeah. And 20% risk free. Similarly, at this point, it would be 100% risky only. So if I this part is basically certain proportion of risky and risk free. It determines where you are standing. So yeah, let me just write down that part. Basically, my blue line indicates that is the this part to this part indicates it is certain proportion of risky and risk free. Then what my this line indicates, that is this line. This line, we have understand the concept of short selling, right? So basically this line is based on short selling. Okay. So this is my graph of the efficient front-end presence of a risk-free asset. So we will revise this first when we do the next class, or if you want to view it again, you could just go back and view again. And basically this part, that is the light blue part, we understood that all the investor would invest in these proportion of risky and risk free according to their risk preference. So basically my blue part indicates all investor would invest in proportion of risky and risk free according to their choice. As I said earlier, if I'm a risk seeking person, so basically, I want higher return. I would always consider my B point because I would always invest in risky assets because I'm a risk loving person. Similarly, if my grandfather, or you can say your father or my father, they would always try to save their money for the future. So they invest in certain risky asset and risk free assets. So if you want to take an example, B is where I lie. That is young people who love risk. Similarly, at point C is where our father or mother lies. So they they love risk, but even they try to be cautious. So basically, both love risk and dislike risk. Similarly, at point A, that is this, I could say that my grandfather lies here because he dislikes risk. So this is how in reality it would. So basically you could lie anywhere between A, B and C. Okay. So as I said, at B point it would be always held as per the market portfolio only. So what is market portfolio? Market portfolio is the capitalization. So I will explain that in the capital market line, so you do not need to worry. So yeah, we are done for the day and we have completed the first part. I guess there would be 3 to 4 parts depending on how much time do we take. So yeah, thanks a lot guys. Bye.